Okay, guys, today we have to discuss this is the general ledger and T count. So, what is general ledgers? General ledger. What is general ledger? So, general ledger is like a master is a master notebook. Okay, for all the financial transaction of a business. General ledger is a master notebook for all the financial transaction. It is where every money related activity gets recorded and organized. So, this is for all financial transaction. By financial transaction means that money related. Okay. So this means that every money related activity gets recorded and organized, and this master notebook, which we call as general ledger. Okay. Now think of it as a big filing cabinet with a separate section. We call that is accounts for each things like cash, like supplies, loans, and all revenue and many more like this. Fine. Now, what is the purpose of general ledger? So we have discussed that it keeps record of everything, so you can see how much money is coming, that how much money is coming in, how much money is going out, and how much money is staying in the business. So this is the purpose of general ledger. Now, how it works? Each transaction is regarding the general ledger under a specific account. Like we have discussed, that they may be cash, maybe supply account, maybe loan account. So this is the work actually the general ledger perform. Now let's move on. We have to discuss the T count. This is actually a big T account. It's like T, so we call that T count. So T account is a simple tool used to visualize how money moves in and out of the account in the general ledger. Okay, so it's look like a big T and help you see increase and decrease clearly. This is like this, and here you will see increase or decrease, increase or decrease. So as actually visualize the monies move in and out. Clear? Now this is the structure of the T count. On the top line in the account, you will have a name that, let's say we have cash. On the left side, we have debit. We denoted this by DR. And credit on the right side, that is your credit. So this is the basic structure. Let me write it here. Here you'll have a cash. This is the name of the accounts. Here you will debit. Here you will have credit. Clear? Now, why use it? Why we're using the T counts as an easy way to track changes in account and make sure everything balances. Because of double entry bookkeeping, every transaction affects two accounts, and that is the reason that we have visualize screen, that visualize thing from which we can get more information very easily. Now let's talk about the elements of the T counts. Elements of T count. Elements of T account. So the first, we have three main parts. The first one is the account name, and that means that what you are tracking, like you're tracking cash, you're tracking supplies, revenue, and so on like that. So actually, account name means that what you are tracking. Clear? The second part, that is debit, that is debit side, and that is on the left side. So usually where increase go for the asset like cash or supply, and decrease for liability and equity. So in this side, let's say if you have purchased some asset, then you will say, you'll record that on the debit side. Let's say we have some equipment, and this is the increase. Okay, so increase will be recorded on the debit side of the asset. Another one is your credit side, that will be the right side, And usually where decrease go for the asset or increase for the liability equity revenue is recorded here. So let's say you have set some asset inventory, then you record here, that will be decrease. So decrease is for the asset, decrease is recorded on the credit side of the account. Okay, now let me show you a quick rule. Asset. So asset means the stuff you own. So increase in asset will be debit, decrease in asset will be credit. Clear? Liability. Liability means your loans, your debt. So when liability decreases, okay, then it will be debit, and when increases, then it will be credit. Same for the equity. Same for the equity. While in case of revenue, so when revenue increases, then that will be credit, and expenses increases, that will be debit, and if decrease, then it will be credit. Clear? Now let's discuss an example for better understanding. For example, starting a business. You start a business by putting, let's say, 1,000 of your own money into it. So two accounts are affected. The first one is cash, and the second one is owner equity. Clear? So in general ledger, you update two accounts. The first one is your cash account. The second one is your equity account. And I have told you that here will be debit, here will be credit, here will be debit, and here will be credit. Now, the cash is N, so we will debit. And equity is increases because you have put the money into the business. So increase in equity will be credit. Clear? So cash increased by 1,000, debit side balance, because it is an asset. This is an asset. While the owner equity increases by 1,000 is a credit side because it is an equity. So this means that increase in asset will be debited, increase in equity will be credit. Okay, good. Now let's move on to another example. Let's say you are buying supplies with cash. Now you have spent 3,000 of their cash to buy the supply. So two accounts affected. Let's say you have spent 3,300. Now again, two accounts affect. The first one is your cash account, and the second one is your supply account. So is we have already cash account, debit side and credit side. And cash account we have already $1,000. Now another account is we will have here is supply account, and here will debit and credit. And supply is your asset. Fine. So you have spent $300, and when decrease in asset, then it will be recorded on the credit side. So the asset is cash, so you record it here. Now supply is also asset, and you have purchased some supply because of these 300 cash. So your asset again. So it means that the cash, which is your asset, decreases, so it will be credit. Now the supply, which is your asset, and it increases, so it should be debit. Clear? So cash decreases by 300, credits are because it's an asset going down, and supply increases by $300, debits are because it's an asset going up. Now cash balance. Now this cash balance, when you deduct this 1,000 was at the start, and now you have removed or decreased it by 300, so the remaining balance will be 700. Clear? So your remaining cash balance will be 700. Fine. Good. Okay, this is all about general ledgers and key accounts. So we have, let me recap it again, and after that we will just wind up this lecture. We have discussed this general ledger, that this is actually the big record of all accounts. Big record of all accounts. Clear? And then you have discussed the T counts. T counts mean a simple T shape to track one account changes. It is actually a simple T shape. If you look at T shape to track one account changes. Then you have discussed the elements, and that was account name, debit side, credit side. Okay, and we have also discussed the debit and credits. This is actually depend on the type of accounts. So when you have increase, let me write it again here, increase in asset, it will be debit, decrease literally asset, increase should be debit, decrease asset should be credit. Liability, decrease should be debit, increase should be credit. Equity, same. For expenses, when expenses increases, that should be debited. Okay, let me write the expense too. And increase in expense should be credit. Clear? So this is the lecture. Now let's move on to the book thing, that what is actually there, and then in here is it. Here. Now look at here. The general ledger. The general ledger is where all double entries are recorded. It contains individual accounts. We have discussed this, like business, asset, liability, expenses. These individual accounts are also known as a ledger account. Okay. Now, financial transactions of the business are recorded in the relevant ledgers. Immediately, a business can get information overview such as cash balances in the business from the cash ledger account and sale generated from the sale generated account. Sale ledger account. So double entry are recorded into the ledger accounts, T accounts, and a T account is graphical representation of the ledger account. It's fine. We have discussed this. Now, here we have discussed the elements of the T accounts. Debit stand, DR stand for debit. Debit entries are recorded on the left side of the T account. This is the left side of the T account. And each type of asset, mean liabilities, capital, income, expenses, will have its own individual account. And the name of the individual account will be appeared here on the top of the T account. So this is the one component. This is the name of the account. This is the second component. And CR, credit, is the third component. CR stand for the credit. Credit entries are recorded on the right side of the T account. Fine, good. Now here you can see, this is actually a T account T shape. You see here like this. Now this is one component, this is another component, and this is another component, and this is the T shape, and that is why we call it T shape. Now here we have a date of the record transaction after. So you will date. Here you write the narrative, the code number, the name, other ledger accounts, and the double entries, and here you will have the value of the transaction. Clear? Now, transaction is sale of goods. When you did some sale, then the bank will be bank or receivable. If it's cash, then it will be bank. If it's on credit basis, then it will be receivable. So debit will be, so increase in asset, definitely it will be debit. And you see here, sale revenue, so increase and revenue will be credit. Payment received from credit customer, we have discussed all these things one by one, and you can do it by yourself. Clear? Okay. Now here is a statement of, here's a question. I think this is the questions. Yes. Asset are what a business owns, liability are what a business owes to other, and capital is their differences. These simple definitions are essential correct. This is the correct term. Asset is what the business owns, and we have an equation, if you remember, that asset is equal to liability plus equity. Yeah. Now, the main principle of the double accounting entry is that every debit entry has an equal and opposite entry, means the accounting equation will always be balanced. So correct. Put simply, the accounting equation demonstrates the asset, debit, capital, credit, liability, credit. One good way of stating the accounting equation is asset minus liability. So it's a very formula of accounting equation, capital represent for investment, business, and asset. So this is the end of lecture, and we have discussed this in a detail. Thank you.